Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. An hour to go until we ring the closing bell. You're looking at a mixed picture here. The Dow up 71 points, S&P and Nasdaq trading to the downside. Investors digesting a slew of earnings reports that we got before the bell today. Caterpillar, Pfizer, JetBlue, Uber, among those results that we got, the mixed results this morning, as well as a couple of the latest data points on the economy. So investors sifting through that. Consumer discretionary, utilities, energy, the worst performers so far today. Well, earnings season is in full swing, but as stocks have soared so far this year, slowing profits could put a dent in the rally. The Wall Street Journal highlighting data showing that earnings are on track to report a 7% decline in earnings for the second quarter, and they will likely slow even further in Q3. Joining us now to break it all down, we want to bring in John Porter, Newton Investment Management Chief Investment Officer and Head of Equity. John, it's great to see you here. So 82% of the results that we've gotten so far have topped earnings expectations. The bar was low. What's your takeaway so far from this earnings season?
No, I think you're right to focus on how the stocks react, because the news has been surprisingly positive. We've seen, revenue beats of a couple of percent on average for the S&P 500, earnings beats of 5 to 6% on average. But the stock reaction so far has been muted. The average stock is gone down about 0.5% on the day that they report earnings. So I think there's information there. The markets run a lot, as we've seen, certainly a tech-driven rally. But expectations were for companies to beat expectations, and they have, but investors haven't been rewarded as of yet for that strong performance.
Yeah, so much of this is, of course, an expectations game. And to your point, the expectations were really low, which is partly what we're seeing, the beats in the quarter. I mean, How do you marry that with what we have heard from some asset managers like Oppenheimer and Morgan Stanley, who are saying that they have raised their price or targets for the S&P 500 going into year end? On the one hand, we're seeing income declines on earnings, and yet because of the rally we've seen, there's a little more optimism, perhaps.
Yeah, a lot to unpack there, Akiko. Look, investing is a second derivative game. So while absolute earnings are going to be down for the quarter, as we discussed, they're going to come in a little bit better than expectations. And although, as Shauna said, Q3 earnings may also be down, I think the trend from here looks more optimistic in terms of the earnings trajectory is going to improve from here. And that's a marked change versus what many investors, myself included, frankly, were thinking at the beginning of the year, where there was a lot of investor angst around market earnings expectations, that the conservative, cautious story has not played out yet. And I think we're seeing a lot of brokers sort of chasing the rally, following the momentum, and respecting the fact that the economy is frankly held up better than most expected for this year.
So, John, then what does that mean looking out to the remainder of the year in terms of that year end where we're going to be for the markets? Where do you see us trending from here on out?
Oh, that's the million-dollar question, right? Look, a lot of people are calling for the market to start to broaden out. This has been a top-heavy led market, the fabulous seven or whatever they're referred to that have dominated the market returns. There's investor expectations that the market's going to broaden out. I would say there's probably more investor hope that it'll broaden out. I don't think there's a lot of evidence to support that it necessarily automatically will. But you're looking at the rest of the market. The broad market looks inexpensive relative to the market averages, because those big cap companies have been so strong and they're somewhat expensive. So I think expecting the market to broaden out is probably a good baseline set of expectations for the rest of this year.
John, let's talk about the broader macro environment. We've been watching the labor market very closely, of course, ahead of the jobs report on Friday, the JOLTS report today, showing that job openings fell to their lowest level since 2021. Now, Fed watchers are pricing in a pause in September. Let's take the labor market as it is right now, because if the expectation is that maybe the Fed will continue to sort of remain on the sidelines until they see the effect, what is the data that we got today tell you about where we are, that whether things are starting to loosen a bit in the labor market?
Yeah, I think I would emphasize the bit part of it. The labor market is starting to loosen a bit, but there's still a long ways to go. I think the labor market is telling us that the Fed's goal, which looked heroic at the beginning of the year of orchestrating a soft landing, looks more reasonable today. They've managed, despite unprecedented hike in rates, they've managed to slow the economy at a modest enough pace that we haven't seen sort of the real backlash of the aggressive headcount cuts on layoffs that you would normally see in a slowing economy. So I think the backdrop right now is set up to lead to the sort of the ideal scenario for the macro landscape of the soft landing, slowing economy, but not a recession in the outlook.
John, do you think the Fed should be done at this point, just given the fact that we have seen inflation cool significantly? You can say at this point, lots of questions about what is necessary, if another hike is necessary in order to get to that 2% inflation target. Where do you stand?
I think right now, given that they've already raised by more than 500 basis points, the next 25 basis points is more for headline purposes than the real ultimate economic impact. I think the question of whether the Fed should be done, I think the Fed should be on pause for a while. But I would say there's a greater chance the Fed has to tighten a little bit more than that the next move is to ease. I think while inflation has come in, quite well, it's still well above their target levels. There's no indication that they're going to change their target. So I think that we continue to be mindful that inflation is still running well above trend, and the Fed may have to take further tightening action.
John, something we were talking about last week when that FOMC decision came down and we saw the moves in the bond market, that inverted yield curve that has remained. I'm looking at where the 2-year is right now, 4.9%, the 10-year at 4%. What do you make of this? I mean, what is the bond market seeing that we're not necessarily, or at least investors aren't necessarily seeing?
Yeah, look, I'm an equity guy. I've spent my entire career as an equity guy. I've been told for my 30-year career that the bond market, that the bond investors are much smarter than equity investors. And, the evidence is that they are pretty darn smart and they're prescient. I'm not sure what the bond market is seeing right now, because clearly, equity investors are seeing a much different market outlook than the fixed income market. And at least for the past few months, the equity market has been more insightful in terms of their market views than the bond market. But you have to respect what's going on in the bond market. And that's one of the things, if you're pointing to signs of concern, that significant inverted yield curve, as inverted as we've seen in probably 40 or 50 years, that's a warning sign that should be heeded.
So, John, let's talk about how investors should be positioning their portfolio given all this. You mentioned the fact that the rally, the breadth they are starting to widen out just a bit. Where do you see the most opportunity here in the second half of the year?
Yeah, I think two areas I would highlight would be healthcare and energy. Maybe focusing on energy for a minute. This is an area of the market surprised me at the weakness so far this year. I think that there's been some greater than expected supply from places like Russia or Venezuela. I think the China reopening part of the thesis hasn't played out quite as investors might have expected at the beginning of the year. Nevertheless, when we sit here today, energy stocks look inexpensive to me. The companies are going to be capital disciplined, that they're fully committed to that. So I think the supply-demand balance is going to be stronger than we've seen in quite some time. The capital discipline is an important dynamic. And to the extent that there's less fears about global economic slowdown, like energy is a cyclical business. And so the demand side should be supported by investors' more positive view towards the macro landscape. So I think energy offers really interesting risk reward here today.
Yeah, John, having said that, I mean, we're talking about tough comparisons when you think about where energy was last year, right? If you look at some of these names that were reported last week, Chevron, for example, roughly 50% decline in terms of their income. Those catalysts that you just mentioned, whether it is a pickup in activity in China, sort of the broader demand, I mean, has it just not taken shape? Is that your thesis? I mean, what's the medium-term trajectory?
Well, I think that there is an element of there is supply constraint by the broad global energy producers. As I mentioned, there's been some surprising short-term supply come from places like Russia and Venezuela. But I see that as transitory, not something that's a secular part of the story. So I see the supply-demand picture being very attractive for energy, particularly with a more favorable view towards the macroeconomic demand. Yes, on a year-over-year basis, the earnings picture right now looks very challenging for most energy companies, but these are a different set of businesses. You're looking more at sequential trends. And when you look out over the next 6, 12, 18 months, I think the growth potential from these current subdued levels of earnings is very attractive for the average energy company.
Okay, we'll be watching to see how they do, and at least in the second half of the year. John Porter with Newton Investment Management. Good to talk to you today. Appreciate the time. We are just getting started here on Yahoo Finance Live. Coming up, can't put a price on luxury cars, at least not according to Mercedes-Benz. The company's shrugging off everything from higher material costs to negative currency effects. We're going to dive deeper into the quarter with the company's U.S. CEO. Plus, a bad rating for Uber. One analyst calls the company a highly overvalued zombie stock, despite the firm posting its first operating profit. He's going to argue his take with a Wall Street bull on the other side. And later, the earnings parade continues. We're going to bring you breaking results from Starbucks, AMD, Pinterest, right after the market close. A busy afternoon ahead. We're going to be right here breaking that all down for you. We'll be right back.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. Let's do a check of the market sponsored by Tasty Trade. Just about 45 minutes left to go in the trading session. The Dow, the only one in the green, up 69 points, while the S&P 500 and the Nasdaq both in the red, with tech and industrials the outlier today. Taking a look at the VIX as well, we are, of course, talking about the fear gauge here, up just slightly at about 1.7%. We're at 13.86. Well, we have seen shares of Uber today under pressure, down more than 6%, despite posting a surprise earnings beat and its first ever GAAP operating profit. Here to uncover the challenges and opportunities of the ride-sharing giant, we've got New Construct CEO David Traynor, along with Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. Welcome to both of you. We know you're on very opposite sides of the spectrum when it comes to where you view the stock. Paul, let's start with you, because Uber really kind of pushing the positive news today, their first operating profits in the quarter, but they also had some of the slowest growth that we have seen since the pandemic began. So is this as good as it gets? Have we kind of reached the peak, at least in the medium term?
Maybe in the medium term, because, the stock is still up 90% year to date. So it's been a smashing success as of late. And for many, many years, since the company's inception, I was turned off on this company. But I've only become more bullish on it recently. And I actually think, not today, I think the stock has to come down and maybe show support at its 50-day moving average, which is $43 a share. I probably would be a better buyer. Because here's a company that's gone from deep losses to about break even at this point, surprise to the upside, particularly on free cash flow. And right now, the street has about 95 cents EPS next year. The way they are annualizing with the most recent quarter, I bet that could end up being $1.20, $1.50. And if I'm right, the stock is expensive, but deservedly so. So I don't buy it today. We successfully support the $43 price at the 50-day moving average. I would buy it there.
David, you're at the other end of this. You're not excited at all, I would assume, despite the fact that Uber did post its first operating profit. Why not?
I mean, Paul makes some good points. I mean, the business is way better than it was before, but the bottom line is that most of this earnings that we're seeing is from unusual gains related to securities gains. It's non-operating. 13 out of the 19 cents is fake. So this business is not looking as good as it may appear. And I think that's a big part of why the stock is down. Investors are smarter about adjusted EBITDA and the false sort of gods that this company has praised in the past. Look, any business that's been run on a number that really doesn't correspond to profits, you got to question. They burned $35 billion in cash. I don't buy the positive free cash flow number. We won't know until the Q comes out and we can actually look at the numbers. But I doubt that on a real cash basis, that this company generated real cash flow. And again, they burned a ton. Going forward, I sort of see this as a peak. I just think the competitive position of this business is not that great. It's, you don't see many millionaire taxi drivers or taxi companies, right? It's not a great business. So I don't really see a long-term profit in their future.
Paul, let me get your take on, at least on the ride-hailing side, because we have seen, Uber start to benefit, on the one hand from the return to office. We have seen corporate travel as well as leisurely travel also picking up, that benefiting Uber as well. But they've also had to spend a lot to bring drivers back. So if you think about the trajectory of this company on the ride-hailing side since the pandemic began, are we at the peak?
I don't think we're at the peak. We'll see what happens next year. However, the thing that I worry about the most is, do we have a recession in the United States next year, or even abroad, and even abroad? And my view is we will have a recession, yes, but it'll be rather short and shallow. So Uber and other companies will be able to not skate through it. They'll be impacted negatively, but be able to survive it. So I don't think we're near the peak on the ride share. And one of the things I like about this model, particularly vis-a-vis Lyft, which is a horrible company, the gang that can't shoot straight, horribly managed, at least to this point, and that is actually a benefit for Uber, is that they're diversified, right? With the transport business, which I see very potentially interesting over time, and also the delivery, which I'm kind of mixed on. But I could see out of the three pieces of the puzzle, transport could be quite interesting and a nice accelerant in the future.
Dave, let's talk a little bit more about that comparison that Paul just made to Lyft. I know you're not excited about the business model for Uber, but comparing it to its biggest competitor out there, it does have a huge advantage. How do you see these two businesses stacking up?
They're both bad businesses. I mean, like I said, the taxi business, the rideshare business, it is a product of, I think, that golden sort of private equity age where they could take anything to market and sell it for huge profits, which is now a problem in the private equity space, but that's a different issue. These things were never unicorns. It's, again, not great businesses. I remember talking to a banker one time that was looking at Lyft, and I said, so at the end of the day, what is the competitive advantage of these businesses? Do they have one? And his only answer, the best answer he could come up with was, well, they can raise more money than other companies. So these firms are about burning lots of cash. And look, to Paul's point, it's a bad business, but competing against bad businesses that lose lots of money, you can never raise prices because they will undercut you. And that's going to happen forever, I think, in this business. I think it's a zero margin business long term. That's why bus services and things like that, you don't hear about Greyhounds making a lot of money. In terms of other businesses they're in, transport, also super competitive, low margin, intense rivalry business. Not likely they're going to go in there and disrupt anybody, make real money. And then food delivery, that's a joke. They'll never make money in food delivery.
David, what are you suggesting when you say the competitive advantage isn't that great? There's not a lot of money to be had here. That ride hailing is going away, or that you don't see a lot of upside. There's not enough revenue coming in. What do you mean when you talk specifically about the ride hailing space? That the advantage isn't great.
It's not going to go away. It's been around forever, right? What's the innovation here? Oh, that there's software that allows anyone to be a taxi driver. It's not exactly a livelihood that people aspire to. It's a hobby. It's not really creating value for anybody at this point, except for the executives and the bankers and the shareholders that are taking home billions and the consumers are effectively getting a value neutral proposition. It's not, I don't think there's a real sustainable value creation there. And it's a trading stock. It's a banker stock. And the executives are making tons of money. I think it's a transfer of wealth from consumers to the executives. And ultimately, when this thing really kind of settles back to earth and fundamentals matter again, it's going to be a big transfer of individual investors to institutional investors and bankers.
Well, Paul Meeks and David Traynor, I appreciate you both coming on, giving us your take on Uber as we see that stock under pressure in the session today.
Thank you.
The strength of the consumer powering discretionary earnings so far this quarter. Jared Blicker is on the floor of the New York Stock Exchange with the details. Jared.
Yeah, so retail trade has been very strong. And let's go to the Wi-Fi Interactive where we can see what has evolved in the space so far this early in earnings season. Now, consumer discretionary, what I'm calling retail here, is having a beat rate of 13.3%, or that's how much they are beating above the consensus. Now, you take a look at the other retail sector, which is staples. They're beating about half of that, or 7%. But also notable, we see industrials have really done well, and communications, that's really a meta story. But I want to stick with consumer discretionary and retail, so I'm going to go to our Wi-Fi Interactive, and I'm going to show you first how the sectors have evolved, because retail really picked up over the last 2 months. What we're looking at here, the top 4 sectors, all up 12% over the last 2 months. We got industrials, materials, energy, and XLY is consumer discretionary. XLP, by the way, is down here at 4%. That's more of a boring sector that tends not to get as much attention, but it does make the items that we need to eat and drink every day. Let's take a look at the retail board here, and we can see a few standouts. I'm going to sort by performance so they stand out. Just take a look at W here. Wayfair up 76%. That has been an interesting stock here today. We had this buildup into the early part of February, a big knockdown, and then a rise over the last 2 months. I keep saying 2 months here because that's when there was a big rotation out of, or at least not solely into the mega caps, and they started diversifying into other sectors here. This chart is going to be a little bit familiar. Let me take a look at AEO. That's the wrong one. ANF. There we go. Abercrombie and Fitch. We do have that rise into January, and then we have this really big liftoff into the over the last 2 months. Also want to point out that Kohl's and Nordstrom each have more than 45% return over the last 2 months. Pretty impressive story considering their largely brick and mortar footprint there. But it's not just these retail stores. We can take a look at apparel. Apparel has really been flying. And there's going to be a little bit of overlap with this board from the previous one. But Children's Place, number 1, that's up 121%. Real up 108%. And you can see here, a lot of these stocks, or at least some of them that I'm highlighting here, have been knocked down into the red. And I'll tell you another thing, if you take a look at a longer term chart of some of these, they're not looking that good. In other words, a lot of these names are just climbing out of a very, very big hole. I could go on here, but it does extend into the food space, the beverage space. We'll have to see what comes of the consumer staples because we haven't gotten a lot of those earnings just yet, but it'd be really interesting to see if this trend does indeed continue, guys.
We will be watching for that. All right, Jared Blick, thanks. Well, safety concerns are piling on for Tesla. This time, the company under investigation for steering issues. We've got the details for you on the other side.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
More safety issues for Tesla. The National Highway Traffic Safety Administration announcing it is investigating complaints about the loss of steering control in some new Tesla models, with at least 5 drivers alleging they couldn't steer the vehicles at all. Yahoo Finance's Pras Subramanian following that story for us today. Pras, how many cars are we talking about that's covered by this investigation?
Hey, Kiko. Yeah, so this is sort of a big deal for Tesla. Around 280,000 Model Ys and Model 3 from the 2023 model year. So just last year, these cars are having complaints of steering issues, power steering failure, steering where people can't turn the actual wheel. 12 separate complaints here. Like you mentioned, those 5 that they couldn't even actually they couldn't actually control the car there. So this is a kind of a big deal for Tesla. 280,000 vehicles is quite a lot. What's happening here is this is the first part of a safety probe by NHTSA. They opened this probe first to investigate the issue, and then if warranted, they would do a full recall. It's unclear as to whether this would be a software update or potentially a whole equipment or steering rack update, which would be a very big expense for Tesla for that many cars. Let's say a part costs $1,000, times that by 280,000 people or cars, you have an idea of how big it could be from a cost point of view. So not an insignificant thing for Tesla, especially when we talk about things like steering and turning, and also other investigations with regards to unintended acceleration and phantom braking that I know, Akiko, you've been following. So it's not just the first time Tesla's had an issue with these issues with the car going with turning and also acceleration.
Yeah, I mean, Pras, 2 questions. What are we hearing from Tesla? Have they responded to this investigation at all? And then to your point, I mean, it feels like even just in the last few weeks, every week brings some kind of investigation into a safety concern. Last week, we had that Reuters investigation saying that Tesla overstated its range. The California Attorney General, we learned, is now investigating concerns about autopilot and potential fraudulent claims. And then you had some of those fatalities related to Tesla fires. At what point does the brand, you think, in the trust that drivers have start to take a hit?
So first of all, we reached out to Tesla for comment on this. We haven't heard back from them yet. They usually are not the most responsive on these things because they've dissolved their PR department. So that's one thing. You mentioned a number of other investigations. You're right. There's the autopilot investigation into cars crashing into emergency vehicles at accident sites. There is the phantom braking issue that I mentioned as well that happens with regards to autopilot. You talked about potential battery fires. There's also there's one just resolved last week where a recall was issued for steering wheels that would come undone in Model Ys. A few hundred vehicles needed a new bolt fastener for that. So I've seen a number of these cases coming up with NHTSA and NHTSA investigations. We haven't yet seen a sort of reputational damage effect yet for Tesla. People are still buying the cars. They had the best quarter ever for Q2 in terms of sales. So we're not seeing that effect yet, but I have to wonder, Kiko, when that might be an issue when let's say other automakers are able to ramp up their EV offerings and offer them at a competitive price.
Okay, Pras Subramanian with the very latest on that. Thanks so much.
Mercedes-Benz has raised its global forecast after the company's second quarter earnings beat the street's estimates. Now, the results come as the automaker joined forces with 6 others to create a supercharging EV network across the U.S. to rival that of Tesla's. Here with more on that and how the business is doing, we want to bring in Dimitris Psalakis, Mercedes U.S. CEO, as well as our very own senior autos reporter, Pras Subramanian. Dimitris, great to see you again. So it looks like, at least from these results, higher earnings and sales in the second quarter. You raised your guidance. Doesn't seem like you're seeing any sense of a slowdown that we've been hearing from some of the other automakers. Give us a better sense of what the demand picture looks like right now.
The demand is pretty stable on our end, and I think this is based on the new models which you have been launching. Just in the first half year, we had the launch of a 5th electric vehicle, the EQ SUV, a US-made electric vehicle with great success in the market. We launched our GLC, the medium-size SUV. So we have pretty fresh and new models in the market which attract customers and keep the demand high. That helps for the results that you just obviously mentioned.
Hey, Dimitris, Pras here. So notice that Q2 in the US, at least, a slight sales dip, but you did have big sales of the EVs and also top-end cars like the G-Class and also some of those, the EQS vehicles. Is that sort of by design here, Mercedes? Is that targeting that higher-end consumer?
On one hand, this very slight drop was based on a model change that we had, the GLC, which was launched in April. The EQ SUV was launched in April, so we had a kind of dip for the first quarter, but all in all, we're back on track. But as you mentioned, on the top-end vehicles, AMGs, Maybach brands, our S-Class are doing pretty well, and we have had a very robust growth year over year on the top-end vehicles.
Hey, Dimitri, so looking at EVs, I saw that EV sales were up 600% compared to a year ago. Now, you didn't have that many EV models out at that point for the brand in the US. What's a realistic goal here for EV sales in the US for Mercedes?
I think we claim that we want to go in a zero emission future, and we'll move in a fast pace on that. We launched our fifth model, the EQE SUV, this year. So 2023 for us has a full range of EVs, starting from the EQB all the way to the EQS SUV, and soon in Q4 we'll launch the EQS Maybach SUV. So based on this product offensive and more products which will come in the next years, we plan to go fast on a zero emission vehicle. It's an aggressive plan. At the moment, with the results of the first half year, we're more or less doubling the market on EVs. We run with 14% share of electric vehicles in our product portfolio, which is pretty impressive for the US market.
Demetrius, what about the fact that we've heard some reports that EV adoption clearly is not as fast as many had anticipated? We're expecting to see, from many of these forecasters are expecting to see a slowdown here when it comes to future EV adoption. Are you factoring that into your strategy at all?
We do, and I think part of it is our the strong effort to take an investment into supporting the infrastructure development. I think the EV adoption is not just having products in the market, it's not just marketing these products, but it's also preparing and having the right infrastructure. Customers are still hesitant on buying an electric vehicle, considering where they can charge, how long can they drive with their vehicle. So there we've been quite active and even, I would say, aggressive. We have announced at the beginning of the year our proprietary charging network, Mercedes-Benz proprietary charging network, and just a week back we announced, along with other 6 brands, the investment on a high charge network in 2024 and onwards. So full on with infrastructure investments.
So Demetrius, following up on that, this North American partnership you have with likes of GM, Stellantis, and others to build this sort of bespoke, new, supercharged sort of network. How did that deal come about? And I know you have a deal with Tesla too. So how are those two sort of partnerships going to work exactly for Mercedes?
I think our effort is to offer to our customers the maximum convenience in charging. So our vehicles will be capable in charging in all available high or superchargers in the US. That would give convenience, that would take away the fear of where can I charge my electric vehicle. That's about our strategy.
So Demetrius, are you also seeing, we talk about pricing in the high-end consumer. We've seen here in the US a few models, EVs and hybrids, actually being priced below MSRP. I did a story on that 2 days ago. Are you seeing that with Mercedes? Are you going to be actually potentially selling cars below MSRP depending on the car and model?
This is, we don't, I mean, we announce MSRPs, but we don't control the market prices. But so far, the experience is that vehicles are selling on MSRP. We have programs with leasing. We have the support of the federal, let's say, support on leasing or commercial leases. So we're using these tools to promote the electric vehicles, but at the end, pricing is in the hands of our network.
Demetrius, in this earnings results, Mercedes coming out saying that they do expect the second half of the year to remain subdued. They do expect, you guys expect inflation costs there to remain higher. How does that then impact Mercedes, given the fact that we still are at risk of a recession in the months ahead?
I would say, on the one hand, we expect a lot to come out of our new model launches, and we have still new vehicles to come in the second half year, like, for example, the SL43. When it comes to electric vehicles, our EQS SUV, Maybach, and other products. So product portfolio is young, is strong, and that creates demand for us in the market. On the other hand, you are correct, we have the headwinds of higher inflation, of high interest rates, which is obviously bringing payments to a higher level. So we try to manage and compensate for that, and are pretty optimistic that the second half year will help us to continue on the strong path we have had so far and close 2023 on a higher level than 2022.
Demetrius, always great to speak with you. Demetrius Salakis, Mercedes US CEO, thanks so much. And Pras, thanks to you as well.
Thank you.
International travel demand boosting Marriott's latest quarter. The company's CFO touting the strength of the resilient consumer in an interview with Yahoo Finance. Don't miss the full interview. That's coming up on the other side.
Strong travel demand and higher room rates boosted second quarter earnings for Marriott International. The company also raised its full year profit forecast and saw a high rebound in international travel. Let's dive deeper into the quarter with Marriott CFO Leeny Oberg. Leeny, good to have you on Yahoo Finance. Welcome.
Thanks. Great to be with you.
This quarter was China-led. What exactly are you seeing in this market? Because I think a lot of investors have been watching the headlines out of China. They're seeing potential for more stimulus. The economy's slowing down, but I didn't see that in your quarter.
So one way to think about this is every part of the world has come out of the pandemic at a little bit different time and a little bit different rate. So you think about a year ago, you saw the US absolutely cranking, and now what you're seeing as China has really relaxed the COVID restrictions, you're now seeing people really be out and about enjoying travel. So while we still haven't seen the same amount of cross-border travel into China yet, 76% has been the traditional amount of travel in China that's generated from domestic travelers. So in that respect, they are all out and about doing group, business, leisure travel in China. And so sure enough, we saw extraordinary growth, more than double in RevPAR.
Are there certain parts of China that are doing better than others? For U.S. investors that may not be familiar with the market.
Yeah, no, I would say overall everywhere, but interesting pieces to your point is Macau in the last couple months has seen an absolutely incredible spike.
Big gambling area.
So we saw, and again, overwhelmingly Chinese visitors. So occupancy over 90% for the last couple months, which in our business is extraordinary. And Hong Kong, while it's still not back as much as mainland China, it's also recovering really nicely. So it's really on all cylinders.
How do the forward bookings look like for China?
Yeah, also really good. So when you think about a group, which you can start to see some visibility out, that's looking strong. Otherwise, our business on the transient side is a fairly short booking window. So things can change quickly, but from the basic pace of what we see, really strong.
Let's get back to the U.S. Are you surprised by the resilience of the U.S. consumer?
No, I'm really not. I think there are a couple things going on. One, I don't think anybody takes travel for granted anymore. It's one of these things where we kind of had come to assume it's always part of life. And I think COVID reminded everyone how much you love to get out for work, for play, for family, drive 2 trips, fly 2 trips, wherever.
I can't stay in my kitchen any longer.
I was going to say, those 4 walls, those 4 walls get pretty tough. So I think that's part of it. But then the other part is, again, this resilience that's coming from leisure came first in a huge wave. But now both business and group are kind of falling in also in terms of big rebounds. And that's really helping support this base level of demand that I think will carry us in the future quite well.
At least for me, I think you had one of the best quotes so far of earnings season on a conference call. I'm a bit of a conference call geek. You said today you see a soft landing. Why is that the case, and what does a soft economic landing mean to you and the Marriott team?
So again, go back to where we were a couple quarters ago, and as you remember, everybody was kind of, expecting that by the time we get to Q3 or Q4, we're looking at a real recession, et cetera, et cetera. What you've seen lately is still really strong employment numbers. Increased expectations for GDP growth. You're also seeing that inflation is calming down, which I think, again, helps everybody think, okay, you know what, we could actually have a kind of a soft landing without a huge downfall. And that, again, gives support for businesses to think about investing. So as they think about going and holding group meetings or going and looking at new projects, when you think there's a bit of a steadier platform to look at for growth, it gives you more comfort about going out and spending that money and sending people on the road.
So then have you seen an acceleration in the number of rooms you're looking to open?
Well, we certainly just added the MGM rooms. So we went from expecting growth in rooms this year of 4 to 4.5% to now 6.4 to 6.7. So that obviously is great acceleration, and we're thrilled with that strategic enterprise agreement. But when I think about the other parts, I would say it's kind of steady as she goes relative to a quarter ago, which is that we are adding rooms nicely. The rooms that are in the US and Europe in particular definitely see the impact of a tougher financing environment. So taking a little bit longer for rooms to go under construction, a little bit longer for them to get financed, but they are getting done. It's just taking a bit longer.
How do you see that playing out? What's the trajectory looking for next year? If the Fed is done raising interest rates, there's, I think, a 19% probability that September that they raise rates, which to me is they're probably not going to do it. What does that mean to your business next year?
Well, again, to the extent that we see a fairly steady environment in the economy, both here and obviously outside is important for us as well, that bodes really well for our business.
We are coming up on another jobs report, and we've talked at length with the Marriott team about it's hard, not just you, it's Hilton, it's all the lodging players, getting the jobs and the people you need to staff those new hotels or staff basic services in the hotels. Where are you at now that the market is slow, job market is slow, maybe some more people out there looking for gigs?
So it has improved. There's no doubt. We actually ended the quarter with about 5,000 job openings.
Still a lot.
I know, but you compare that to pre-COVID, actually was 6,300. So it's actually, we're in fine shape. We are seeing the turnover rates calm down. We're seeing the interest in the industry pick back up. So I would say a much steadier environment.
Is there something that needs to be done to get people into these jobs, new training, new approaches to get this into this industry? Because really, this industry is, you can start on the bottom and very easily work your way to the top over the course of 10, 20, 30 years.
It's one of my favorite things about our industry is that it is all about the people and all about the way they work together. And it is a classic apprenticeship industry where you absolutely, I think about so many of the top leaders at the company, and they overwhelmingly started in, positions like bellman or front desk associates or restaurant associates, and now lead huge parts of the company. So it's a wonderful thing to see. But when you think about kind of what we're doing for the associates, I think the answer is we always want to try to be doing more. It's a core tenet of who we are. Take care of your associates and they'll take care of your guests. But if you think about some of the work that went on last year, increased our match on 401k, started an employee stock purchase plan, really looked hard at labor scheduling opportunities that now are done through an app that's much easier to say, you know what? Next week, because I've got something going on with my family, I really can only work 2 days, while this week I can work 6. A lot more flexibility.
Lean, you really have major street cred, longtime CFO of Marriott. You're on that Adobe board, really a decorated Adobe board. What are some of the biggest challenges executives like yourself are up against right now?
I would say the one that I probably spend the most time on is speed of change. And obviously technology has a huge amount to do with that. And when you think about how rapidly you see new apps come and go, new businesses come and go, new tech, AI, all the things that are going on with generative AI, it really does reinforce how quickly companies need to be able to adapt. And we're a big ship. We are a big company, and we're working really hard to be as nimble as we can, looking at our markets, looking at our technology, and really excited about what we see going forward.
Does this new technology change the role of CFO? Because in the near term, you have to meet these results, you have to meet Wall Street expectations, but you hear all this new technology and all these investments you might have to make just to do well 10 years from now. I mean, it has to make things more complicated.
Well, one of the things I really have always loved about the CFO role is the intersection between business strategy and capital. And at the end of the day, that is really what it's all about, is devising business strategies that are going to allow you to achieve for your consumer and for your associates what you want, but then thinking about the best way to do that. What is the way that will generate the best returns that allows you to access that capital to make them successful? And it is where those things intersect that, frankly, are no different than they were 10 years ago. The topics may be a little bit different. Technology clearly is only a bigger part of that conversation. But at the same time, it's really all about trying to be successful in your business strategy.
All right, Amazon expanding its virtual health clinic service nationwide. Amazon Clinic initially launched last November as a virtual platform connecting users with healthcare providers to treat common conditions. Yahoo Finance's Anjali Kamlani joins us now with all the details. Anj.
That's right, Shauna. The latest of the Amazon healthcare saga, if you will, one of their latest efforts to really gain market share when it comes to the provider side. So we know that Amazon has had many different iterations of this before, but now they're expanding what they launched in November nationwide to all 50 states. And it basically is like a telehealth service, but it also includes messaging visits for some states, and 34 states specifically is where it's allowed. It is a 24/7 sort of opportunity, which really helps, I think, with what you see out in the real world, which is restricted hours for physical locations, even with telehealth in some instances, really restricted on what you can access. So this offers access to about 30 common types of issues, health issues, as well as the ability to get your prescription sent either via the Amazon pharmacy or to your local pharmacy. Now, the key part of this, of course, is that they do not work with insurers just yet. So that's something that they're probably still working on. And it is available for a cash pay. So $35 for the messaging part of it, and then $75 for video. That $75 is a little bit on the higher side of what you see out in the market. We have seen others that are a little bit lower price point for video visits or messaging visits. So it'll be interesting to see how they compete in that space. I got a chance to speak to the general manager of Amazon Clinic just about what this opportunity means for Amazon and how they really see their customer base and who they are. And, in that interview, the general manager said that they've built a marketplace for third-party providers or for provider groups whose goal has always been to follow the customer demand and the feedback. And what that really means from Dr. Hugo is that they have essentially created what you know as Amazon, the marketplace, the e-commerce giant, but for providers now. So that's how they're sort of creating this situation where we have access to doctors in the same way you have access to whatever it is that you shop for on Amazon. So that's the latest. It's just the latest for Amazon, large company. We know we covered their Health Scribe tool for providers, as well as the acquisition of One Medical and also the pharmacy. So this is just another step that we've seen this company take, and it could be probably the closest we see to sort of disruption to the traditional healthcare space right now.
All right, we will see what the uptake looks like here as Amazon once again continuing to really increase their footprint in the healthcare space. Anjali Kamlani, thanks so much. Well, coming up, the closing bell on Wall Street. We're checking in on the latest market moves. You're looking at the Dow up 76 points. We'll be right back.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
The closing bell on Wall Street. Let's do a check of the market sponsored by Tasty Trade. The Dow closing in positive territory on the first trading day of August. S&P and Nasdaq, though, closing to the downside. The Nasdaq off just about 0.5%. Biggest laggards today in terms of the sector action, consumer discretionary. The XLY off just over 1%. We're also seeing some losses in healthcare, energy, and consumer staples. Let's take a look at some of the big movers of the day. First up, shares of Caterpillar jumping to a record high in today's session after beating estimates on both the top and bottom line. The company also saying that its full year operating margin will come in at the top end of its previous guidance. We saw the excitement, Akiko, in shares on the heels of this news. And we know many investors look at Caterpillar as a bellwether here, not only for the U.S. economy, but really for the global economy. So the fact that demand has remained resilient here, obviously a strong sign for the second half of the year and going forward.
Yeah, Shauna, certainly a broader commentary on this macro environment that we're seeing. I mean, we've been hearing so much about the construction boom, and that is really reflected in the numbers that we got from Caterpillar today. We're talking about not just new homes, but industrial construction projects that are taking place, non-residential construction, accounting for a majority of the company's equipment sales. Part of that is what we've seen coming through from D.C., whether it's the infrastructure bill, CHIPS Act, the IRA. You know, we've heard so much about those investments taking shape. The one thing that I thought was interesting, though, is that the company talking about the slowdown they're continuing to see in the Chinese market. Remember, the CEO back in April said that total share of sales would be about 5 to 10% below normal expected range. And then today we heard the company say yet again that they expect it to be even slower. So sort of interesting when we're trying to get a better gauge of what that rebound or lack of rebound is looking like over in the Chinese market. Well, Norwegian Cruise Line shares sinking today despite beating Wall Street's estimates. But its third quarter guidance that's hitting the stock today amidst estimates for what is supposed to be the best 3 months for cruise operators. And you see that stock down more than 12% in the session. Norwegian now expecting adjusted earnings of 70 cents a share in the third quarter. And Shauna, this has got to be disappointment because we've been talking so much about the pent up demand that, you know, customers increasingly are willing to spend on this. That guidance just didn't come in where investors wanted it to be.
It wasn't. And Akiko, this almost seems like a reality check here for investors. But the bar, though, was set very high. We've gotten very strong results from their two largest rivals. So investors had very high expectations going into these results. So any sort of disappointment, I think we were prepared to some degree to see some pressure on the stock. But again, a big drop today with shares closing off just about 12%. We take a look at the numbers. It wasn't too bad for the quarter. Revenue did beat the street's expectations, up 86% year over year to just over $2.2 billion. But again, that bar set very high from the rivals here, and Norwegian falling below what the street was hoping to see. Stifel was out with some reaction commentary today saying that today's weakness, they view it actually as a buying opportunity, though, because they believe expectations are way too elevated for this company when compared to Royal Caribbean. So again, they're seeing a little bit of a buying opportunity here, but across the board, there was so much expectation for that very, very strong, resilient consumer, very strong demand. So Norwegian just falling a bit short there. Let's also take a look at Tupperware. This stock has certainly been on a tear in recent days. Shares surging another 25% today. The gains reminiscent of that meme stock mania that swept the markets in recent years, and the reaction, the action, I should say, in general, that we've seen in Tupperware, really proving the fact that the meme trading frenzy remains alive and well. Akiko, short interest is the highest level that we've seen in more than a year. And this is a stock that's been trending on some of those retail investor favorite sites like StockTwits, like Reddit, helping to explain why there's so much interest in a name that Tupperware has warned that they could maybe potentially not be around here for much longer. So the investor interest, you got to kind of second guess and question where this is coming from.
Yeah, among the top traded stocks today in the session, right? This is a company that back in April said it was near bankruptcy. We're talking about shares at roughly $1, right? At the beginning of July. And here we are, the stock price is more than quadrupled. Shauna, I think I have stopped trying to explain some of this meme trade, but it is interesting to see what the excitement is. I mean, I don't know.
Yeah.
You know, the other name, by the way, that's also trading among the most traded today, Yellow, which is a trucking company. I mean, there's a number of those stocks that were starting to sort of percolate through this meme frenzy, but I mean, we'll see if it sticks.
Yeah, if you buy in, you got to be prepared to lose it all, at least with names like that. All right, let's talk about another name that's on the move today, DoubleVerify, the advertising data platform, failing to impress the street with its second quarter results. You're looking at the stock closing off just over 14%. It's the latest reading on the health of the ad market following mixed results that we got last week from some of the largest players in the space, Snap, Meta, and Google. So here with more, we want to bring in Mark Zagorski. He's CEO of DoubleVerify. Mark, it's great to see you here. So revenue of $133.7 million, meeting the street's expectations. You reaffirmed your full year forecast. What can we learn from your results that's indicative of the broader ad market economy right now?
Yeah, I think it's an interesting take because, as you noted earlier, there's a little bit of variability in what's going on in the ad market. There's definitely winners and losers, and since we're pretty equally spread across the ad market, we get to see a lot of it. So our growth, which was definitely in line with analyst expectations, we actually beat on the EBITDA line and gave pretty solid guidance for the rest of the year. Saw certainly spikes in certain areas. So our social business grew at over 31%, which is a really nice growth rate. Our programmatic business grew, particularly our ABS product grew at 51%. And I think what it shows is that expectations are pretty high for an advertising rebound, but that advertising rebound across the board is a bit uneven. One other interesting proof point that we've seen is the ad rebound outside of the U.S., particularly in international markets, has been much stronger. Now they're coming from a much lower base. They had a tough ad year last year. But markets like EMEA for us grew at 33%, and APAC grew at almost 50%. So for sure, we're looking at some uneven growth, but it certainly feels better. If you ask, our advertiser clients, it feels better than it did at the beginning of the year. So I think we are coming to, a turning point.
Yeah, Mark, you mentioned that rebound that we're seeing is uneven. We certainly saw that reflected in big tech earnings that came out last week, whether that was from Meta or Alphabet, talking specifically about digital ads. Where are we seeing the biggest upside if you're talking about the ad space overall?
Yeah, I think, social continues to grow, and I think driven by short form video. Right. So the revolution driven by TikTok, which has now been adapted by Meta through their Meta Reels product, and YouTube through YouTube Shorts, is really driving a lot of customer engagement and attracting a lot of ad dollars as well. So I think you're seeing social continue to grow, and social that's focused a lot on short form video. I think traditional digital media is where there'll be some challenge. So traditional publisher focused digital media is still, I think, challenged. So I think social for sure, connected television, CTV growth, a lot of expectations there. We're still seeing a nice volume growth there, but the competition is growing too. With the addition of HBO Max, Netflix with an ad-supported tier, Disney Plus with an ad-supported tier, you've got a lot of quality inventory coming into the CTV space, fighting over ad dollars. So, areas growing that are solid: social, short form video, continued growth in CTV, challenge digital areas, maybe traditional digital publishing.
Mark, you announced an acquisition of an AI ad tech firm. I'm curious, from your perspective, how is AI revolutionizing the advertising industry? And in order for companies to take advantage of that, who's done that best so far?
Yeah, AI does touch everything. And beyond being a buzzword, there are real applications for it in the digital media world, particularly around the idea of optimizing ad spend. So 85% of digital media outside of social and search is bought and sold programmatically. And programmatic advertising is all about bidding and finding the right bid at the right time for the right impression. The ability for AI to supercharge that bidding process and the ability for AI to make sure that the advertiser is delivering against their KPIs, I think is a real value proposition for advertisers. And I think it's going to be a turning point for how ads are bought and sold, even in a more aggressive programmatic way than it has in the past.
What about generative AI? I mean, that's the thing we're trying to figure out. AI, the technology, has been utilized in ads for years, and we've seen it really sort of fine-tune, being able to target the right customer. But where does Gen AI play into all of that? How do you see that?
Yeah, Gen AI is interesting because it will touch both the buy side, but also the sell side. Gen AI can be used to create dynamic advertising, right? And change ads on the fly for individual consumers, individual advertisers. It's also being used, though, in a probably not greatly positive way in actually creating what's called made for advertising content, and kind of perpetrating huge amounts of websites and content that's been created by machines, not written by humans, that are kind of proliferating all over the internet. So generative AI, has the ability to do some really interesting and positive things, but it's also creating tons of content. And some of that content can be considered misinformation or disinformation or not brand safe. And that's where I think, that's a place where companies like ours come in to ensure that, an advertiser is not just buying an impression the most efficiently, but buying a quality impression that's brand safe and brand suitable. So generative AI is really starting to touch lots of different aspects of advertising.
All right, Mark Zagorski, great to get your perspective on all that. CEO of DoubleVerify. Thanks so much.
Thank you.
Well, Starbucks just out with its quarterly results, earnings coming in at $1 a share, beating the street's estimates of 95 cents. Revenue missing the street's expectations at $9.17 billion. The estimate was for $9.28 billion. Same-store sales also falling short, rising 10% versus the expectation of 11.1% for the U.S. Comp sales rising 7% against the U.S. 7.7% estimate. Akiko, one bright point here in this earnings results is really what we're seeing in terms of China. We know China was a focus in this result here. China comp store sales coming in, increasing 46%, on a year-over-year basis, beating the street's expectations of 41.8%. So a bit of a recovery playing out in China, but not enough to offset some of the weakness that we're seeing elsewhere, with the stock off just about 1%.
Well, in China, you could argue when you look at the stock moves, sort of investors looking at that growth in China, yes, that's really good news. But at the end of the day, the broader trend is slowing growth for Starbucks. Mm-hmm. When you think about where this company has been, they have really benefited in a big way in the return to office with those ticket prices going up. They've been able to push those prices higher as well, looking at record sales in the quarter. But broadly speaking, that is starting to slow down. And I think you see that reflected in the stock as well. You talk about same-store sales being a miss. North America same-store sales also a miss, coming in at 7% growth as opposed to roughly 8%, a little more than 8% that was expected. The other thing that kind of stood out to me, just looking very quickly at the report that came out here, operating margin of 21.7% contracting from the prior year. Companies saying specifically that was driven by previously committed investments in labor. In that labor story, to me, I continue to watch with Starbucks. It's going to be interesting to hear what kind of commentary we hear from them. It's not just about the union moves that we have seen, but also just about the broader labor market. Starbucks really always a pretty good indicator about where those labor costs are. So that'll be interesting to hear what they have to say on the earnings call. That will be very interesting, and something that I'm sure analysts are going to want to know a little bit more about. When it comes to some of the average ticket prices here, this jumped out to me as well, Akiko. That rose 4%, beating the street's expectations of a 2.5% climb here. In North America, the average ticket price was up 6%. International was up 2%. We talk about the fact that people are paying more for their goods every time they go to Starbucks, paying more for whatever it is that they're buying. So the average ticket prices there increasing on a year-over-year basis. We also know that they put a lot of emphasis on their loyalty program. That was up 15% from a year ago to 31.4 million. So critical here for Starbucks in order to get those returning customers on a regular basis. What that's enabled the company to do in terms of growing their revenue at a time, like you were just saying, with growth slowing just a bit here in the U.S. Yeah, those loyalty points increasingly important, not just for Starbucks, but so many of these, sort of food and beverage companies. That just makes it a little stickier at a time when consumers are increasingly having less and less discretionary spending to be had. But of course, we're going to continue to watch the stock move there. The shares of Starbucks off just about 0.2% there. Well, coming up, we've got breaking results from Pinterest, the company beating on the top and bottom lines. Shares there, though, down nearly 4%. We're going to break down the numbers for you on the other side.
Pinterest reporting second quarter earnings moments ago. Earnings coming in above expectations, 21 cents a share versus the street's estimate of 11 cents a share. Revenue also topping expectations, $708 million. That was against the street's expectations, $699 million. Now, this is what the company said for its outlook in the earnings release. Quote, we currently expect Q3 revenue to grow in the high single digits range year over year. We expect our Q3 non-GAAP operating expenses to grow in the low single digits range on a year over year basis. Well, joining us now to break it all down, we want to bring in Headline Venture partner Cameron Ansari. Cameron, it's great to have you here. So the earnings just crossing a moment ago. They beat on the top and bottom lines, yet we're looking at shares under a bit of pressure here. Why do you think that is?
You know, I have no idea why this happens. I was reading someone on Twitter is like, look, they beat on the top and the bottom. The shares are down a few percent. I think there's lots of stuff that happens as soon as earnings come out that are sort of beyond my comprehension, or maybe even most folks that are hedge funds and stuff covering positions, and people that are making immediate trades as soon as earnings come out to try to capitalize on small bits of volatility. And some of the smaller cap names, like Pinterest is a relatively big company, but doesn't have the float or the volume of a Meta or Google. So, you know, if a couple of funds are moving positions around right at the close, then, you know, that can impact the pricing.
Cameron, you know, we were talking to a guest earlier about just where the digital ad market is right now. We have learned through earnings so far that it really is uneven in terms of the rebound, depends on whether you are a Snap or you're an Alphabet and a Meta. Based on the numbers that we're seeing today from Pinterest, what does that tell you about what Pinterest is getting right in this environment?
Well, I think these companies are all very, very different, right? I mean, Meta is the most scaled social media play you can possibly have. 3 billion users globally. It is a behemoth, and if you're an ad buyer that's going to place ads on one platform, it's probably going to be Meta, right? Between Facebook, Instagram, and WhatsApp, they have all of that kind of spend covered for you. So that's a very different thing. Google, obviously, with their search business and the behemoth that is YouTube, which continues to grow very well for them, and video ads continue to perform very, very well for Google. That's bolstering their results. I think Snapchat, basically suffers from the fact that it's fundamentally a messaging app, that the content is really embedded within the messaging. It's not really a place where you go to truly kind of watch videos or review content or do search. So they're obviously, trying to kind of insert ads within the messaging, and they're in the middle of this long ad overhaul they've been undertaking for I think at this point it's been a year or two or something longer. So Snap's in that process. Now Pinterest itself, I think, is doing well, and as you saw from the results today, they beat on the top and the bottom line, and I think they're benefiting from sort of this different environment where they're kind of a pure sort of Disney-esque consumer internet property where there's not really political speech or hate speech or content that might be questionable. It's pretty clean, wholesome content around interests. Fashion, apparel, exercise, fitness, cooking, gardening, and home repair, and this kind of thing. So I think those categories are popular and continue to be so, and they're great categories for the kind of bulge bracket Fortune 50 type advertisers.
Cameron, in this report, monthly active users, that was up 8%. We're looking at that number as 465 million right now. As it stands, we're about 1 year into Bill Ready being the CEO of Pinterest. And we know that he's really been focused on expanding the business beyond just advertising. He wants to have more of a focus on shopping. They have that strategic partnership that they announced with Amazon a couple of months ago. I guess, how would you characterize, or how effective has Ready been in really transforming Pinterest and setting Pinterest up for this new stage and this focus that they are placing on shopping?
It's at the 1 year mark, right? And I had the fortune of working with Bill when he was at Braintree and at PayPal. And he's terrific. I think he's a great person to lead the company. And Ben is still there as a chairman. So I think Ben and Bill kind of work together in many ways. And Ben was the original founder and CEO. I think that what he's done is put the pieces in place for the next kind of 6, 12, 18 months. And those pieces are, he made some changes on the executive front. So they replaced the CFO. Todd Morgenfeld stepped down, and a new woman, Julia Donnelly from Wayfair, has stepped in. They put the partnership with Amazon in place as an announcement, but the Amazon ads deal is not live yet, I don't think, and largely probably won't go live in any full way until the end of the year or later. So we'll see that kind of play out over time. And I think that the big mission that he's on is to capitalize on, you said, 470, 480 million users globally. They're mostly outside the US. That's like 80% of that user base or something to that effect is outside of America. And they're in high value markets like Western Europe, Australia, Canada, Japan, Brazil, on purpose, right? Pinterest established itself with a foothold in those countries. And it's time now to see, can they monetize those users? So I think that's going to be the next 6, 12, 18 months is can they capitalize on shopping, which is his big push. And I think part of the reason for the Amazon deal is hopefully to see some more shopping activity happening within Pinterest four walls. And then international growth and the other things that are coming into place.
Cameron, to that point, some of these new ad tools that were introduced, Premier Spotlight, some of these other ones that target travel specifically. I mean, it really feels like the company is sort of, better understanding the user that's specifically on Pinterest. But you talked about the international exposure that they have, potentially more than some of their competitors. What does the outlook look like on that front? How much does that exposure point to broader slowing down, at least if we look into year end?
Well, I think international actually is a big bright spot for them, because that is where they have so much untapped opportunity, in that they have users, they have people on the platform in these countries. And again, they're not in, Twitter and some of these other platforms have users in lots of places that are fairly kind of low value, low monetizing places. Whereas Pinterest, on purpose, deliberately, put these local versions of Pinterest in countries where they thought they could actually monetize. So they're in Germany, they're in France, they're in the UK, they're in Brazil, they're in Japan. And only in the last kind of 12, 18 months or so have they started to turn on advertising in those markets. So it's very nascent. Western Europe, Canada, Australia were first, the UK. But then these others like Latin America and Japan, they're just starting to do advertising there on Pinterest. So we'll see, how does that catch up? How does that, average revenue per user, the ARPU number, which is what everyone looks to, how does US ARPU start to look like compared to the international ARPUs? And I think over time, the Western European ARPUs, certainly UK, France, Germany, those should start to look relatively close to what the US has today.
Cameron, when you take a look at the year-to-date performance of Pinterest, it's up only 14%, so much lower performance when you compare it to some of its larger rivals. within the space. What do you think is missing from that picture? What do you think investors need to see in order to get more comfortable with a name like Pinterest?
Well, I think a big piece of it is the international. Can they actually start to show that outside of the four walls of the U.S., the international market is going to monetize for them and monetize well? That's been a promise, and I think it's starting to get there, but it hasn't, fully kind of realized yet. And the second, the big thing is shopping and commerce. Can they actually perform something meaningfully, revenue-wise on the shopping side? Because there have been many, attempts before. Buyable pins was the most famous example from several years ago, which they launched. You could buy stuff on Pinterest. It didn't go very well. They sort of shuttered it. And they've had other iterations since then with Walmart and Target and Home Depot, where you can buy stuff through those partners within Pinterest, go to Walmart, and then come back to the Pinterest site. But this is going to be the big test to see, can they actually monetize shopping in a meaningful way on Pinterest?
All right, well, Pinterest shares off almost 4% here in extended trading. Cameron Ansari, great to have you. Thanks so much.
Thank you.
Well, AMD just reporting earnings, and we're seeing those shares getting a big lift on the back of that. The stock up more than 5%, with earnings coming in better than expected. Earnings per share coming in at 58 cents a share, beating the estimate by a penny. As for revenue, that came in at $5.4 billion versus the estimate of $5.32 billion. Shauna, a few things to point out here, though, because this was some of the concern going into this report from analysts looking into AMD. Data center revenue missing there. That was sort of indicated when we saw Intel's numbers last week, pointing to kind of a muted outlook. Gaming revenue also a miss, coming in at $1.58 billion versus the $1.6 that was estimated there. And we are, Lisa Su in the statement coming out today saying the third quarter, we expect our data center and client segment revenues to each grow by a double-digit percentage sequentially, driven by increasing demand for EPYC and Ryzen processors. So the outlook right now, the company's seeing revenue of $5.4 billion to $6 billion right now. So sort of, the estimate was at $5.84 billion. So kind of right along the consensus there. The stock, though, getting a big lift there now, up more than 6%.
And when it comes to the data center, they're kind of countering some of the fears that were out there on the fact that maybe we would see clients here hold off on server spending in favor of some of that newer AI technology. But it does look like the demand is there. A lot of focus within this report on AI, and specifically what AMD is doing in AI, that push there. The company saying that they're making further inroads in AI computing. And in the statement here, Lisa Su also saying that our AI engagements increased by more than 7 times in the quarter as multiple customers initiated or expanded programs supporting future deployments of Instinct accelerators at scale. So again, third quarter revenue, they expect $5.4 billion to $6 billion. Compared to the average analyst estimate there of $5.8 billion. So essentially, like you were saying, in line at the midpoint of that expected range. But again, some excitement in the stock and extended trading with shares up just about 6%. So certainly better than what the street had been anticipating. Let's do a check of the market sponsored by Tasty Trade and where we close the day. The Dow closing up just around 71 points. S&P and Nasdaq in the red, with the Nasdaq closing off about 0.5%. Coming up, glass half empty. AB InBev's pain is Molson Coors' gain as it picks up market share on the Bud Light boycott. But investors are not wearing beer goggles. Shares sliding as sales miss the mark. So is it Miller time? We're going to discuss all that coming up next. Welcome back to Yahoo Finance Live. Josh Shaver, proud Supermanian, joining me to break down some of the other stories that we're keeping an eye on. And guys, I'll go first here because this story really stuck out to me. One of the headlines crossing today that CBS is teaming up with Nickelodeon. They're going to offer an alternate broadcast here for the Super Bowl this year, a slime-filled Super Bowl. It's geared obviously towards the younger generation for kids, so it's offering a family-friendly broadcast here. I think this is such a smart idea. Get more and more people excited for the game, get kids into it. They can share in that excitement with their parents. So I think it could be a huge home run here.
Shauna, we got to highlight, that's the best SpongeBob episode ever, right? That they put out in the trailer with the Super Bowl halftime show. So I think that's a nice play right off the top, right? I love that episode. But I think overall,
I never knew you were such a SpongeBob fan.
I love that episode specifically. But I think it's interesting play when you look at sort of from an NFL perspective and what they might be trying to do here just to get kids more involved, and just a smart play if you're Paramount, right? You already have the Super Bowl, so why not add an alternate broadcast? You see a lot of other networks are starting to do this, right, Pross, with how ESPN has done things with their other personalities, like a Pat McAfee now does a bonus broadcast. So interesting to see Paramount saying, well, we might not have a lot of sports gambling content that we can do a secondary sports gambling broadcast, but we can do a kids broadcast. And so I think that's kind of an interesting spin when you think about, okay, I have the rights. I paid billions of dollars to have these rights. How can I maybe get a little bit more out of them? And I think that's kind of my read through of what the play is from Paramount.
So a couple of things. I saw this playoff game a few years ago when they did the Nickelodeon broadcast, and it was interesting, but I thought, would kids really like it? I'm not sure. But I think it makes sense to do this alternate broadcast. I mean, the Manning cast, like we've seen from Monday Night Football, is a huge hit, getting in more viewers who want to have more of a laid-back experience. Maybe there's something there for a parent to watch the game, but then also have the kids kind of have fun with the slime. I know they have special graphics on the screen. You get slimed in the end zone, stuff like that. I just don't know if it's, I mean, is it going to take viewers away from the main broadcast? I don't know. I mean,
I don't know how many it would necessarily take away from the main broadcast. Obviously, some there. When you take a look at the previous numbers when they've done this in the past, now it has not been for the Super Bowl, but they did this in the past for a wild card playoff game. They also did it for a Christmas Day game. And the viewership numbers that I had, right around 2 million for one of those games, just under 1 million for another one of those games. So they are able to attract viewers, right? How many of those viewers maybe wouldn't have tuned in if they didn't have this broadcast? I'm not sure, but I do think it does add an element of fun. I think there is no downside, Josh, to what you were saying before, just in terms of offering this, getting a little bit more out of the money for their deal. Yeah. Whether or not it's really going to move the needle, I'm not too sure. But I do think there will be some excitement given the fact that there's so much hype around the Super Bowl.
As someone that just likes sports media discourse too, it'll be interesting to see if people even flip to this to watch part of it, because I know that was a big part of the Nickelodeon broadcast the last couple times.
I watched
part of it just to see it. A lot of the pundits online watched part of it just to see it, right? You comment about it, you see the slime. But now we're dealing with the Super Bowl, so like, are people going to be willing to change the channel to even see what it looks like? Or do they get way less viewership? Because if you don't,
you got to think it's not the diehard fans. Right. They're not going to take the chance on the Nickelodeon.
When the Patriots are in the Super Bowl, this year,
or the Eagles,
I will not be watching on Nickelodeon. But I might be drinking a Miller Lite.
Okay.
I might be drinking a Miller Lite, and I thought that was an interesting thing. Another story I'm following today is Miller Lite. Molson Coors, they had earnings out earlier today. And we saw the trend that we've been talking about for a couple months now, guys, a decline in Bud Light sales. What did that mean for Molson Coors? Molson Coors delivered its single strongest quarter of net sales since Molson and Coors merged in 2005. Now, revenue did come in actually a little bit lower than analysts had projected, not by much, but they singled out that Bud Light sales have been declining, and it led to benefits for what they've seen in Miller Lite sales, Coors Light sales. Now, the most important highlight of that, though, the stock closed down today because some of that might already be sort of priced into the story, right? We've been talking about this story for a couple months now, specifically over here in our little roundtable, and it seems like we might have already seen some of these benefits into the stock already.
Yeah, I mean, look, I'm just still surprised at the lasting staying power of this Bud Light sort of boycott. We saw Modelo sales be the top-selling brand in America for beer, and now we're seeing Molson Coors brands Coors Light Coors Light and Miller Lite topping Bud Light. I mean, look, they're all substitutable.
What was the face on Coors Light? We can get into it. Are you not a Coors Light fan?
They're all the same. Coors Light, in my opinion, is like worse than Miller Lite. And worse
I think they all
Bud
basically
Light.
taste the same, and that's what this discourse has been.
So it's not surprising that you would like, substitute one light-filling, very, very, just like water-type beer for another one. But it's like, I'm upset about the Dylan Mulvaney thing, right? That's the audience or the viewer or drinker sort of reaction. So I just can't. I'm surprised at how long the staying power is. I saw a report today that Bud Light wholesalers are saying we don't see this ending. This is going on for a long time.
That's the part, Sean, that I think is interesting, and that's what a lot of street analysts are saying too. Is to Pros's point, if they all taste like water, and I already switched to a different water, who really cares what kind of water they drink?
I guess if you're saying, I actually think Bud Light is pretty good. If we're going to be judging the taste of it, I think Coors Light
with a
is
lemon,
fine.
with a lemon only.
With a lemon, that's what I always say. It helps it taste a little bit better. But I think this also just speaks to a larger issue. And we've talked about this time and time again. This boycott coming at a very tough time for Anheuser-Busch, really for any player within this space. When we talk about the fact that fewer and fewer people are drinking beer, they're opting for other alternatives that are out there right now. So combining that with this boycott, clearly it's a very, very tough time for Anheuser-Busch. In terms of the reaction that we're seeing in the stock today, Josh, I think you're exactly right, because I think a lot of this has already been priced in. We've seen a number of analysts on the street either upgrade their outlook for Molson Coors, raise their price targets because of the fact that this boycott was lasting so much longer than I think almost anyone had anticipated. Whether or not that is gone for good, we're hearing more and more people say, to what you guys were saying, that is exactly right. We're not going to see people shift back to Bud Light. So I think the question now is what exactly is going to be the strategy from Anheuser-Busch? What can they do in order to regain some of that market share? Maybe it's not betting so much on beer. Maybe it's betting more so on that ready-to-drink cocktail, on some of the other options that younger drinkers tend to gravitate
And one other thing I want to highlight while we're talking about this, of course, is Anheuser-Busch earnings are on Thursday, right? Yeah. And I just took a look. The stock is only down 5% year to date, which when you think about how much we've been talking about this, how much the sales have been down, we've seen sales fall as much as 30% on a weekly basis for Bud Light compared to the year prior. And I think part of it is, in a larger context, in America, we focus so much on Bud Light because a lot of people drink it here. But Anheuser-Busch is a global company, and I think they'll probably talk a lot about that on Thursday and the other parts of revenue that they still have going. But it's going to be interesting to see how that stock reacts on Thursday, because the numbers aren't going to be good. And they're going to have to admit that things aren't going that well. So what is the turnaround strategy? Can you see that stock not fully tank on Thursday when the bad numbers come out?
Real quick, you mentioned other types of drinks. Spirits overtook beer recently, and I think Cutwater, is that the name of that brand that Bud owns? That's like the mixed drink sort of alternative. That's doing well. All my favorite hard seltzer is doing well. So maybe that's where we're going to see that growth. So turning to, or sticking to stuff that doesn't taste that great, Mr. Beast, the YouTuber, you heard about him. He has a burger chain, apparently. I didn't know about it. A Mr. Beast burger, sorry, not a burger chain. A Mr. Beast burger. Apparently, he's been selling them through a Ghost Kitchen service called Virtual Dining Concepts. And apparently, surprise, surprise, the burgers don't taste good. Apparently, some of the enjoyers of this burger said it tasted, quote, revolting. So Mr. Beast, of course, is suing because he can't have his name associated with the revolting burger. He's suing for sort of reputational damage there. We'll see what happens. But look, I'm not turning to a YouTuber to get burgers, let alone expect them to be good. So it's not surprising to me. It's just weird that people actually do buy these Mr. Beast burgers.
I think it's interesting how it gets into the social media influencer entrepreneur types that then try and expand themselves into pure businesses, right? And like what a ghost kitchen is, like you're kind of franchising out your product. And so to see that product not come out that good, to me, isn't that shocking? I don't love ordering from ghost kitchens. We all live in Manhattan or in the Manhattan area. There are plenty of ghost kitchen places that are ghost kitchens when you order from them. And I think it's just hard to control the quality, which is why the overall
What are we talking about here? Does Mr. Beast having burgers? Like, what is this conceit?
I have an opinion on Mr. Beast. Josh is a very good chef, but you're a tough
I have an opinion on Mr. Beast.
It's not a serious story. This is not a serious story. I'm sorry.
I just think this is a cautionary tale for so many influencers out there, right? You're trying to expand too quickly. You don't have that quality control. You're trying to get your name across everything. If you do that and you're not careful about it, it can come back to bite you. This very much is, right? If people are saying that's that terrible, it's the worst burger that they've ever had, it's revolting. You're going to think twice maybe before going in to a business that maybe you don't exactly have the expertise in, which is exactly what happened with Mr.
So
Beast.
because it's Mr. Beast though, Pras, this is the final like existential question here. Like actually, does it impact a social media influencer's brand at all when something like this happens?
I think that it does.
I would say no. I think people that are mad at him are not Mr. Beast fans. They're people that are like, they know who Mr. Beast is, but not as hardcore fans. I would doubt that his hardcore fans would get that disappointed by a cheeseburger.
Are you the lawyers for virtual dining concepts over here? It's like,
Yeah.
there's no reputational damage to Mr. Beast. Oh, he's fine, he's fine. Burger's
I
fine.
think it does. I'm going to take the flip side of that. I think it does hurt.
All right.
And it's going to hurt anyone else, any other social media star, any other star in that sense, trying to push into something they don't necessarily know a heck of a lot about. All right, Josh, Pras, thanks so much. We're going to leave it there for today. But coming up next, more on Yahoo Finance Live. Stick around. I haven't looked
Well,
at
consumer
all yet.
concerns surrounding electric vehicles are easing, according to a new survey from AutoList. They found worries around battery life and range are slowing thanks to wider access to fast charging networks like Tesla's, but there are still concerns about pricing. Joining us now is David Underkoffler, the editor-in-chief of AutoList. David, good to talk to you today. You know, despite all the talk about maybe a slowdown in EVs, if you look at the last quarter, there were record sales, right? I mean, up more than 50% year on year. We're talking about roughly 8% of the market. The new car sales in the market are made up of EVs. So my question to you is, how much of that remaining 90+% is actually in play? How many drivers are actually still considering buying EVs?
Oh, that's a good question. I would imagine that it's always tough to sort of predict the future. But EVs are certainly very quickly addressing many of the consumer issues that they have with it. So we're seeing concerns about affordability decrease. We're seeing concerns about range decrease, and then the charging infrastructure. So, it's always difficult to predict when sort of full adoption will happen, but I don't want to call them inevitable, but many consumers are really starting to think that this is a type of vehicle that's going to fit into their lifestyle.
So let's talk about those two key things you point out. It's the price, and then there's the range. What's the bigger hurdle for those who are considering potentially looking into EVs right now?
So it's always been price. We've been running this survey annually since 2019. We took 2020 off because of the pandemic, but we've always seen the top three concerns, and those are in order: price, concerns about range, and then where people are going to charge them. However, the number of people concerned about price is decreasing. That is becoming less of a concern in the years we've been doing this survey. It dropped from, let's see, it was 42% of respondents this year said that was a concern. Last year was 49%, and that's just in a year. So we are definitely seeing that ease considerably and in a nice timeline.
On the pricing, how much of that ease has to do with the incentives that have taken shape? And we talk a lot about the federal incentives, roughly $7,500 for new cars. But you add the state incentives, depending on where you live, that's got to really slash the price of an EV right off the top, right?
It can, and it certainly makes it certainly more attractive. I will say it's a bit of a mixed bag right now. The Inflation Reduction Act changed which vehicles were eligible for the full federal tax rebate. And so some vehicles are now on that list that were not previously, but it also took some other brands off. And it sort of depended on sort of twofold, where the vehicle was manufactured and where the battery is sourcing its materials. So I know Hyundai and Kia are out with a great lineup of plug-in hybrid and then fully electric vehicles. Most of those vehicles are now ineligible for the short term if you buy it. There is some loopholes there for leasing, but so there was, it was a mixed bag as far as which vehicles became more affordable. But yeah, certainly, I'm from California. You could take, if you're eligible in terms of your income and the vehicle is eligible, it can knock $10,000 off the price of one of these EVs, and that's pretty significant.
David, one of the things that stood out to me in your study, where you say resistance to EVs is becoming even more entrenched, particularly around low-income shoppers. What's happening there? Because so much of the discussion around EVs has been the inequality, about the affordability, in that it is the higher end consumers who have charging networks around them that have benefited the most.
Yeah, that's a great point. And we definitely saw that most acutely in this survey. I think it's twofold. For one, EVs have always been sort of portrayed as it's for early adopters, or Tesla sort of set the narrative that they're these aspirational, pretty expensive vehicles. It has taken a while for EVs. They're so new still that there aren't many of them, or there's a perception that there aren't many of them on the used market, which would then bring prices down. And then there's also sort of an issue with trucks. Truck is a body style that Americans love. Only now are we seeing electric trucks, and so it's going to take some time before those trucks start entering into the used market. That may drive down prices. So right now, EVs are seen as sort of this unattainable type of transportation for low-income buyers. And it's not just the products. Like you said, it's access to charging infrastructure. In our survey, we found that a number of lower-income shoppers could not identify or did not notice or know of charging infrastructure in their community. And that's certainly a big hurdle because, if we want these to be adopted nationwide, it cannot just be something for higher-income communities.
Finally, David, we've been talking a lot about Tesla opening up their charging network and whether that, in fact, sets the standard, the NACS, which Tesla has, versus the CCS. Does it ultimately matter which standard there is? Because at the end of the day, there's just not enough chargers out there, right?
True. There's certainly not enough chargers. I don't know if it'd be better to ask an engineer what the difference between the specific charging standard. We're in a sort of VHS versus Betamax moment. And as long as they just pick one and the automakers adopt that, I think it will make things easier for consumers. They don't have that issue of, okay, I'm driving this EV, but I'm pulling into this supercharging station. Is my EV going to be able to plug into the Tesla network? I will say, Tesla, they've certainly done a great job with their 18,000 supercharging stations. And not only are there's certainly a large number of them, but they're also reliable. I think if you talk to people who own EVs that are not Teslas and they're using other charging networks, there's a lot of pain points in those charging networks themselves. So to adopt Tesla's standard and to give other brands access to the supercharging is really going to make it a lot easier for consumers.
Yeah, charging reliability, a big key point for a lot of drivers out there. David Underkoffer, the editor-in-chief of Autolist. Good to talk to you today. Appreciate the time.
Likewise. Thank you.
Well, coming up, it is closing time here on Yahoo Finance. We're going to recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
Let's take a look at a couple of stocks trending after hours. Starbucks, Pinterest, Match, and Electronic Arts, EA. Let's kick it off with Starbucks. That stock off just about 1% in extended trading. Comp sales on a global basis falling a bit short. Slower traffic in the U.S. weighing on Starbucks results here for the latest quarter, but higher prices helping to offset some of that slowdown. One area to highlight where we did see some strength was in China. Sales growth there coming in better than expected, something that investors are keeping a close eye on. Now, over the last 3 months, we're looking at Starbucks off just about 11%. Year to date, the stock essentially flat, up just about 2%. Clearly a consumer story here, whether or not people are willing to shell out as much as they had been historically on some of their items here. Starbucks, that stock under a bit of pressure in extended trading. Let's take a look at Pinterest. That stock up just about 19% year to date in extended trading. We're looking at gains now of just about 0.5%. Now, the report was pretty solid here for the quarter, beating on the top and bottom line. Second quarter adjusted EPS of 21 cents. Monthly active user count, that coming in better than expected at 465 million. But this muted reaction in the stock that we're seeing in extended trading, some of that has to do with the total expenses. Total expenses, that grew 11% on a year-over-year basis. So year to date, we're looking at Pinterest up just about 19%, clearly lagging some of the peers in the category. Over the last 3 months, we have seen some of the excitement return to the stock, with shares up just about 31%. Let's take a look at Match Group, the dating app company. That stock up about 11% in extended trading, jumping on its revenue forecast for the third quarter. Total revenue per person for its most recent quarter, that beating the street's estimates at $17.41 here per person. Tinder, revenue accelerating there, improving user trends. They're also benefiting from that new weekly subscription package that we had heard about in the past, and they also plan to expand that into areas in Europe, also into Japan. When it comes to Hinge, direct revenue there up 35% on a year-over-year basis, 24% increase in payers. So it looks like people are willing to spend on some of their dating apps. Over the last 3 months, we're looking at gains of 28% year to date. That stock up just about 11%. So we're seeing a move of 11% here in extended trading. All right, let's take a look at Electronic Arts, EA, getting a pulse here of the gaming market. That stock off nearly 4%. The results coming in a bit softer than expected for the quarter, but the company did maintain their full year guidance. Net bookings of $1.58 billion. That was just shy of the street's expectations, but revenue did come in better than expected, some of that due to deferred bookings. We also saw some strength, what EA noted here in this release, from Star Wars Jedi, The Survivor. That's helping results here for the latest quarter. Year to date, gains of just about 11%.
Well, it is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Ford resuming production of its F-150 Lightning pickup truck. One of its plants in Michigan was closed for 6 weeks to retool and expand its production capacity. The car maker saying price cuts led to a 6-fold jump in orders. BlackRock and MSCI facing scrutiny from House Republicans over its China products. U.S. Congressional Committee on China alleges that the company's offerings are facilitating investments into blacklisted Chinese companies. The move showing how geopolitical tensions between the U.S. and China are rippling into corporate America. BlackRock is denying any wrongdoing, while MSCI says it will review the inquiry. And Tesla shares sliding over new safety concerns. The company facing a federal investigation into steering problems from nearly 300,000 Model 3 and Model Y vehicles. There were a dozen complaints tied to the issue.
Time now for what to watch on Wednesday. A slew of earnings results are in store for investors. We'll get a deeper read on the consumer across several categories. Kraft Heinz is up first with a look into spending behavior in food shopping. Then after the bell, we'll hear from DoorDash. We'll get a glimpse into food delivery demand. PayPal, Shopify, and Etsy is going to give us a glimpse into the digital footprint of consumer spending. And shifting over to the semiconductor industry, Qualcomm is expected to report its third quarter results. An indication of recovery in the smartphone market will be a focus for investors. Last but not least, Occidental Petroleum will point to how lower oil prices compared to a year ago is going to impact the company. Now, looking to the economic front, the ADP employment for July expected to see a change of 190,000 jobs added to the U.S. private employment. This comes ahead of Friday's jobs report for a wider look at the U.S. labor market. Well, that does it for us today on Yahoo Finance. Be sure to come back tomorrow, 3 p.m. Eastern Time. We've got your coverage leading up to and after the closing bell. Have a great day.